Good afternoon, everyone. We are the Group 5, and our topic is all about vertical and horizontal analysis of financial statement and limitations of financial statement. In this topic, we are going to discuss the introductions of financial analysis, vertical analysis, horizontal analysis, and the limitations of financial statement. But before we are going to proceed in our topic, let me first introduce myself. I am Trillianis Jelly Roseby, and I will be the one to discuss the horizontal analysis and the financial analysis. Introduction. What is financial statement or financial analysis? Financial statement analysis is an important business practice that companies use to track financial data and make predictions and comparisons. Companies perform financial statement analysis to help monitor and make sense of data in financial statements, such as income statements, cash flow statements, and balance sheets, and more. Financial statement or financial analysis, it is to provide insight into the financial position of a company or individual. So by analyzing financial statement and ratios derived from them, analysts can identify trends and patterns that indicate the overall performance and the stability of an entity. So this information is essential for making informed decisions regarding investments, loans, mergers, or acquisition. By analyzing these statements, can provide insights into potential problems and opportunities of a financial analysis. And it can also help a company develop financial strategies and prepare for the next quarter or year. So therefore, financial analysis, it can contribute to heavily a company's overall success. So this type of analysis can also help a company secure investors. Kasi yung investors so often conduct comprehensive research into a company's financial statements. So it can use financial analysis to make sense of a company's financial data and compare one organizations to another. So this can help them predict which company is more likely to experience financial growth and be an attractive investment. As I said earlier, financial statement analysis, which is the process of examining a company's financial statement. It is to develop strategies, is a valuable skill for financial analysts, accountants, and other finance professionals. And financial analysis, it is crucial tool used by individuals, businesses, and organizations to evaluate the financial health and performance of an entity. So it involves the examinations of financial statements such as an income statement, balance sheets, and cash flow statements. It is to assess the profitability, liquidity, solvency, and the efficiency of an organization. It is to see if the companies or in that particular organizations, if meron ba silang growth or may nag-i-improve ba sa company nila. So with that being said, we have two common types of financial statement analysis. So which is the horizontal analysis and vertical analysis. It is knowing this, how to perform these practices, it can help you better understand a company's financial data and pick out trends and patterns. So to discuss with, I am going to discuss to you the horizontal analysis. So what is horizontal analysis? In horizontal analysis, also known as trend analysis or time series analysis, it is a financial analyst look at financial trends over period of time, especially quarters or years. Typically, financial analysts perform horizontal analysis before vertical analysis, and it is usually the most useful for companies that have been operating for a long period of time. So, in this horizontal analysis, before ka makagawa ng vertical analysis, you need to do the horizontal analysis. Kasi nga, Sa horizontal analysis, you can compare figures from one time period to figures from a base time period to get an overview of changes over time. So, analyzing financial trends over a period or years, it can help you track how many or how a company's financial state has changed. So, find patterns in this data and spot potential problems and opportunities. Like, for example, you could use horizontal analysis to compare a company's profit margins in one year. It is profit margins in another year. So alternatively, you could use it to pinpoint specific areas of that company that are experiencing the most financial change, kung may nagbabago ba sa company. So based on your analysis, you could then create recommendations for the company to consider to maximize its financial success. So for you to be able to perform the horizontal analysis, you need to follow the 3 steps to perform a simple horizontal analysis. So we have here gather informations or gather financial statements. So because horizontal analysis is conducted on financial statement across periods of time, start by gathering financial statements from different quarters or years. So it involves in this gather financial statement, it involves comparing financial statement from different years to identify trends, patterns, and changes in key financial indicators. To perform the first step in horizontal analysis, one must gather necessary financial statement. So the first step in horizontal analysis is to collect the income statement, balance sheet, and the cash flow statement for at least 2 consecutive years. So this statement provide valuable information about the company's revenues, expenses, assets and liabilities, and cash flows. Next is we have here the compare the statements. After gathering your statement, choose which line items to analyze. Compare the statement or the same line items that different statement to determine how amounts have changed over time and express the change as percentage or dollar amounts. So in the second step, the first statement emphasized the importance of calculating percentage changes. It is for each line item of the financial statement. So by dividing the difference between 2 periods of the base period amount, one can determine the percentage change. So this method provide a clear understanding of how each line items has changed over time, allowing for a comprehensive analysis. And the last step is the identify patterns, trends in the data. So tapos na natin na-gather yung financial statement or tapos na natin na-compare yung both statement. So punta na tayo sa identify patterns and trends in the data. So horizontal analysis, it can help identify seasonal fluctuations or cyclical trends within a business. For instance, retailers often experience higher sales during holiday season. So by recognizing these patterns through horizontal analysis, companies can better prepare for future periods of time or high demand. So horizontal analysis is an essential tool in accounting that allows businesses to identify patterns and trends in their financial data. So by comparing financial statement from different periods of time and calculating percentage changes between line items, companies can gain valuable insights into their performance and make informed decisions moving forward. So we have here the example of horizontal analysis. So we chose the balance sheet. So given the horizontal analysis in Excel of a comparative income statement. So we have here the year 1, year 2, and year 3. So using these aforesaid formulas, we have computed the absolute change in US dollars. So and percentage change, which is the percent. So of all of the line items in the income statement between year 1, base year, and year 3. So in this example, we can see how much any items such as net income increase or decrease from year 1. So to year 3 in absolute and percentage terms. So in other words, we can calculate how much net income increase or decrease from year 1 to year 3, or for that matter any year. So here, net income has decreased by 2,750 or 12% in year 3 when compared to year 1. So secondly, in second type of horizontal analysis, we are interested in knowing about the underlying trends in the lines items of the income statement. So for this, we compare the absolute change, dollars, and percentage change. So in all lines items from one period to another. So one should ideally take 3 or more accounting periods or years to identify trends and how a company is performing from 1 year or accounting period to the next year or accounting period. So here, for the sake of illustrations, so we have shown that absolute change in the US dollars and percentage change. So of all line items in the income statement between year 1 and year 2 only. So the computations of the same have been done in columns F and H. So such analysis provides valuable insights into why of these line items rose or fell sharply or market in year 2. So compared to year 1. For example, net income could fall sharply in year 2. So despite a rise in sales due to a marked rise in the cost of goods sold, so marketing expenses, administrative expenses, and or depreciations expenses. So this type of analysis, it is also a very useful in an investor wants or to determine the performance of a company prior to investing in the same. For example, if an investor may want to evaluate the performance of a company over the past year, so relatively to the base year in order, you need to decide whether it is worthwhile or investing in that company, or worth it ba siya mag-invest in that company. So you need to evaluate the performance of a company over the past year. So that's all my report. So Acosta Patricia will be continuing our discussion for today.
What is a vertical analysis? Vertical analysis, which is also known as a common size analysis, is similar to a horizontal analysis. It can be performed on the same financial documents. However, financial analysis prefer a vertical analysis, vertical inside of a column rather than horizontally across time periods. What is a vertical analysis? A vertical analysis can be used to both internally by a company employees and externally by investors. Investors can use vertical analysis to compare one company to another. Vertical analysis also makes it easy to compare companies of different sizes by allowing you to analyze their financial data vertically as a percentage of the base figure.
So in vertical analysis, it translates figures in financial statement, no. So ito yung mga percentages or mga percentage of a base figure which has a value of 100%. So using these percentages, it can make the data easier to visualize and understand. So in vertical analysis kasi, one line on the financial statement shows a base figure of 100%. So in the other lines represent a percentage of the base figure. For example, ito yung example. When you perform vertical analysis on a balance sheet, no? So, the base figure is the total asset of liabilities. So, on an income statement, so the base figure is the net sales. So, another example is using the total sales as a base value and restating each sales category as a percentage of the base value. So, yun yung vertical analysis. Yun how you do it, a vertical analysis. So, later on, I will Miss Acosta will be presenting or will be discussing to you the example of vertical analysis.
So, good day everyone. I am Patricia Aracosta and I will be the next reporter. And now, I will going to discuss on how to perform vertical analysis. So, first is we have choose a financial statement. To begin your vertical analysis, locate the financial statement that you would like to analyze. Typically, vertical analysis is used on the current year's statement, but you could also analyze previous years. So, vertical analysis is a method used to evaluate and compare different components of a financial statement by expressing each item as a percentage of a base figure within the same statement. So to start, choose the financial statement you want to analyze, such as income statement, balance sheet, or cash flow statement. Usually, the current year's statement is used, but you can also perform vertical analysis on previous year's statements for trends analysis or comparative purposes. So, once you've selected the statement, you'll allocate each line item as a percentage of a specific base amount within the same statement to assess its relative significance and relationships with other items. So next we have analyze amounts located in the same column of the statement. So next, choose the appropriate column of the statement and look at the numbers that are located vertically within the column. So after selecting the financial statement for vertical analysis, the next step involves choosing the appropriate column within that statement. For instance, in an income statement, you might select the column representing revenue, expenses, or net income. And in balance sheet, you could choose the assets, liabilities, or equity column. So once you've selected the column, look at the numbers vertically within that specific column. These numbers represents the various line items or components corresponding to that category throughout the statement. So each number within the chosen column will be used to calculate the percentage for the vertical analysis by comparing each line item to a common base amount within that same column. So next is calculate each amount as a percentage of a base figure. Finally, take the amounts from the column and calculate each amount as a percentage of the base figure, which has a value of 100%. Review the ratios to determine the company's financial state and make the recommendations as necessary. So, finally, to conduct vertical analysis, you'll take the amounts from the selected column in the financial statement and calculate each amount as a percentage of the base figure, which is set as 100%. So, this involves dividing each line item by the base figure and multiplying it by 100 to express it as a percentage. So, for example, if you're analyzing an income statement and net sales in your base figure set at 100%, then every other line like cost of goods sold, operating expenses, and etc. Would be calculated as percentage of net sales. So once you've computed this percentage for each line item within the column, you'll review these ratios to gain insights into the company's financial state. Comparing this percentage over time or against industry benchmarks, it can help in identifying trends, strengths, weaknesses, or areas that might need to improvement within the company's financial performance. So based on the analysis, the recommendations can be made to optimize operations, control costs, increase revenues, or address any financial aspects that require attention to improve the overall financial health of the company. So next slide please. So this is the example of vertical analysis or income statement. So consider the following example of an income statement of the XYZ company. So as you can see here, we have a table. So in a column 1, we have the sales, cost of goods sold, gross profit, salaries, rent and utilities, marketing, other expenses, total expenses, net income. And the second column is year 1 and the next is year 2 and year 3. So if we divide each line item for the year by sales for that year, the common size analysis of the income statement of the company will look like this. So this in a second table. So by converting each number by the sales number for the year, comparing the line items over the years is easy. So the company's gross profit grew in dollar items, as you can see here in table 1. Then, but the gross profit in percentage dropped over the years, as you can see here in table 2. And it shows that the cost of raw materials and goods has increased and is not in the line with the increase in sales. And also, the salaries of the employees have decreased over the years, as you can see here in the percentage table. Then, rent and utilities, marketing, and other expenses have remained more or less constant as a percentage of the sales. Then the net income has increased by about 1% every year, as you can see here. And percentage table, in year 1 we have a 27%, then it added 1%, so in year 2 it become 28%, then in year 3 it added also 1%, then it become 29%. So next slide please. So now let us discuss the horizontal analysis versus vertical analysis. So altogether, there are few main similarities between horizontal analysis and vertical analysis, including first, both horizontal and vertical analysis can be used by internal and external stakeholders. So both methods are utilized by both internal and external stakeholders for assessing financial information and making informed decisions about the company. So next is, both forms of analysis can help you pick out trends and patterns in financial data and develop strategies. So in identifying trends, both analyses aid in identifying trends, patterns, and changes within financial data, assisting in strategic planning and decision making. So next, both forms of analysis can help you analyze various financial statements, including balance sheets and income statements. So both horizontal and vertical analysis, it can be applied to various financial statements like balance sheets and income statement, providing insights into different aspects of the company's financial state, performance, and structure. So, however, there are also differences between the two that are important to understand. The primary differences between horizontal and vertical analysis include: horizontal analysis is performed horizontally across time periods, while vertical analysis is performed vertically inside of a column. So horizontal analysis is conducted horizontally across different time periods, examining changes over consecutive years or periods, while the vertical analysis is performed vertically within a single column, comparing various lines items as a percentage of a base figure. So horizontal analysis represents changes over years or periods, while vertical analysis represents amounts as percentage of a base figure. So, this horizontal analysis showcases changes or fluctuations over multiple reporting periods. While the vertical analysis, it represents each item as a percentage of a figure within a single reporting period. So, horizontal analysis usually examines many reporting periods, while vertical analysis typically focuses on one reporting period. So, horizontal analysis typically covers many reporting periods to analyze trends and changes over time, while the vertical analysis predominantly focus on one reporting period, assessing the proportions of various line items within that period. Then, horizontal analysis can help you compare a company's current financial status to its past status, while vertical analysis can help you compare one company's financial status to another's. So, horizontal analysis, it can help you in comparing a company's current financial status with its past performance, while vertical analysis is comparing the financial structure or proportions of one company's statement to another's, highlighting relative compositions rather than changes over time. So that's all for my topic. Thank you. Next reporter, please.
Limitation of financial statement. The limitation of financial statements are those factors that a user should be aware of before applying on them. To an excessive extent, knowledge of these factors could result in reductions of invested fund in the business or action taken to investigate further. Limitation of financial statements. Financial statements are derived from the historical costs. Many intangible assets are not recorded as a asset. Instead, any expenditures made to create an intangible assets are immediately charged to expense. This policy can be dramatically underestimate the value of business, especially one that has spent a large amount to build up a brand image or to develop a new products. It is a particular problem to set up companies that have created intellectual property, but which have so far generated minimal asset. Financial statements only cover a specific period of time. A user of financial statements can gain an incorrect view to financial result or cash flow or a business by only looking at one reporting period. Any one period may vary from the normal operating result of the business, perhaps due to sudden spike in the sales or seasonally effects. It is a better way to view a large number of consecutive financial statements to gain a better view of ongoing results. Limitations of financial statements. Financial statements do not contain some intangible asset. Transactions are initially recorded at their cost. This is concerned when reviewing the balance sheet, where the values of asset and liabilities may change over time. Some items such as marketable securities are altered to match changes in their market values. But one other items such as fixed assets do not charge. So the balance sheet could be misleading if a large part of the amount presented is the base historical cost. Financial statements are not adjusted for inflation. If the inflation rate is relatively high, the amount associated with the asset and liabilities in the balance sheet will appear inordinately low. Since they are not being adjusted for inflation, this mostly apply to the long-term asset.
Good day, ma'am. My name is Alimar Aziz Jumrani, and I am the next reporter. I will continue discussing about the limitation of financial statements. Financial statements may not be comparable. If a user wants to compare the results of different companies, their statements are not always comparable because the entities use different accounting practices. This issue can be located by examining by disclosures that accompany the financial statements. So basically, it means that we cannot compare the financial statements if the different companies. Why? Because companies are using different accounting practices, and when we say accounting practices, it's the purpose and activity of recording the day-to-day financial operation of a business entity. We really don't know the exact financial of companies, but that is why financial statements are not comparable. And the next is financial statements could be wrong due to fraud. The management team of a company may deliberately skew the result presented. This situation can arise when there is undue pressure to report excellent results, such as when a bonus plan calls for payouts only if the reported sales level increase. One might suspect the presence of this issue when the reported results spike to a level exceeding the industry norm, or well above a company's historical trend line of reported results. Financial statements do not cover non-financial issues. The financial statements do not address non-financial issues, such as the environmental attentiveness of a company's operation, or how well it works with the local community. A business reporting excellent financial results might be a failure in these other areas. Based on my understanding, financial statements are not holding any non-financial issues that companies have. For instance, are those environmental attentiveness of companies' operation, and how does companies related to other community matters. Next is financial statement may not have been verified. If the financial statements have not been audited, this means that no one has examined the accounting policies, practices, and controls of the issuer to ensure that it has created accurate financial statement. An auditor's opinion that accompanies the financial statement is evidence of such a review. If you say that financial statement, it should be verified and certified. If financial statements have not been audited, it literally means that it doesn't not examine the accounting policies, practices, and other related process that need to be done, because financial statements need to be accurate. And the last, financial statements have no predictive value. The information in a set of financial statements provides information about either historical results or the financial status of a business. As of a specific date, the statements do not necessarily provide any value in predicting what will happen in the future. For example, a business could report excellent results in one month and no sales at all in the next month because a contract which it was relying has ended. So basically, it means that all the information that was given for financial statement in any state of information results, it's either in business or historical related, doesn't exist an exact value or information, and it doesn't predict or forecast the future happen. Just for the instance, we cannot predict the sale or the business report in the next or in the other month.
That's the end of our report. Thank you for listening. Once again, we are the Group 5.